Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global. Last week, global LNG markets remained focused on the Middle East tensions. Escalating conflicts between the US and Iran continued to lift international LNG and crude oil prices, while buying interest from Northeast Asia also strengthened regional spot prices. Additionally, after weeks of disruption caused by heavy rainfall across China, domestic LNG demand finally started to recover. These factors might have been expected to drive prices higher, but that wasn't what happened. China's domestic LNG prices continued to fall, even as international prices moved higher on escalating geopolitical tensions in the Middle East. So why wasn't stronger demand enough to change the market? And what does that tell us about where China's LNG market is heading this week? Joining us today is Gary Gao, Gas and LNG Markets Research Lead at My Steel Oil Chem. Gary, welcome back.
Thanks, Nikki. Happy to be here.
Let's start with demand, because that's where the story seemed to change. Logistics improved as the rain eased, and China LNG consumption picked up. Were you expecting that recovery to have a bigger impact on the market?
Initially, yes. After several weeks of weather-related disruption, stronger transportation demand was definitely encouraging. Last week, China's total domestic LNG consumption rose by around 4% from the previous week, and China LNG sales volume by truck at plant also increased as producers lowered prices. But beyond the demand figures, the underlying picture remained unchanged. Supply was recovering faster than demand.
So demand wasn't enough to support the market?
I wouldn't say demand wasn't important. In fact, it was moving in the right direction. The issue was that the improvement simply wasn't large enough to absorb the additional supply entering the market. That's why China's LNG prices continue to trend lower, despite better downstream buying activity.
And was there anything unexpected behind the increase in supply?
China's domestic LNG production continued to recover as more plants returned from maintenance, which was largely expected. What stood out was imports. LNG import arrivals reached 1.56 million tons during the week, up nearly 11% from the previous week. Despite growing concerns over geopolitical risks, LNG arrivals into China remained high.
That's quite a contrast. It's easy to assume that higher geopolitical risk would mean tighter supply.
Exactly, but that wasn't really the case in China. The conflict between the US and Iran pushed international LNG prices higher and heightened concerns over regional energy infrastructure and shipping routes. However, those concerns had yet to disrupt LNG supply into China. Import arrivals remained strong, while more domestic LNG plants resumed operations. As a result, supply remained more than sufficient despite the pickup in demand. That's why recovering demand alone wasn't enough to reverse the market's price direction.
Another factor was import costs. International LNG prices rose sharply, while receiving terminal prices in China moved lower again. Import margins fell to around minus 2,296 yuan per ton this week, down about 955 yuan per ton from the previous week. That's quite a gap.
It is, and I think it highlights how differently the two markets were behaving. International prices reflected geopolitical uncertainty and rising supply risks. In contrast, China's domestic market was still driven by ample supply, with LNG availability continuing to outpace demand. As global prices climbed, import costs increased by nearly 12% during the week. But receiving terminals were unable to pass those higher costs on to the domestic market, putting further pressure on import margins.
So international prices were setting the cost, but not the selling price.
You're right. China's domestic buyers remained cautious, with purchases largely limited to immediate production needs. Until demand catches up with supply, higher international prices alone are unlikely to push China's LNG prices higher.
And inventories seem to tell the same story. Plant inventories increased again, even though China LNG sales volume by truck at plant improved.
I think inventories were the clearest indicator last week. LNG plant inventories increased to 621,000 tons, while receiving terminal inventories climbed to around 5.92 million tons. Both are expected to increase further this week, suggesting the domestic market will remain well supplied.
For this week, with demand expected to remain fairly steady, what do you think will drive the market?
Supply will remain the key focus. More LNG plants are expected to complete maintenance, keeping the domestic production ample. The market will also be watching import arrivals and inventory levels closely. Demand is expected to remain broadly stable, while production costs are likely to stay largely unchanged, offering little support for higher prices. For this week, China's LNG market is expected to remain well supplied, with the average ex-plant LNG price easing to around 5,200 yuan per ton, and the average market price declining to around 5,650 yuan per ton.
And geopolitical tensions in the Middle East remain the key uncertainty facing the global market.
Absolutely. Further geopolitical tensions could continue to push international LNG prices higher and keep import costs elevated. But for China's domestic market, supply remains the dominant factor. China's LNG prices may remain on a downward trend this week, particularly if demand fails to improve meaningfully.
Gary, thanks for joining us and sharing your insights, and thanks to everyone for listening. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LNG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.